Hey folks, the information we're about to talk about could mean the difference between you being stuck renting forever or being able to buy. Click below to subscribe and tune in to the Mortgage 101 podcast with Anthony and Manley.
Picture this, rates are dropping like a T-Rex in freefall. Most buyers are still walking around like it's 2024. Meanwhile, the savvy ones, they're hiding their winning offers inside a Barbasol can, just waiting to pop the lid when the market's distracted.
But Anthony, isn't it too risky to jump in right now? Prices could rise, bidding wars could get worse, and I don't even know where to hide my Barbasol can.
We're in a shifting market, Manley. Demand is waking up, supply is still sleepy, and half the battle is just getting approved. The other half, slipping your offer into the seller's hands before the competition even smells it. You gotta be timing the market, and the market is timing you.
In today's episode, we'll crack open the Barbasol can and show you exactly how to pack it with the right pre-approval, killer offer terms, and buyer tactics so your dream home doesn't get eaten by the market velociraptors.
We do not want you to have a house on a hill stocked full of top ramen. We want some Chipotle in your life. And that's why the DTI is in place.
You love hot dog soup, Anthony. I know you love hot dog soup.
You can call us Houdini. We are that magic 8-ball where you shake it and you see the purple sauce and go, oh my gosh, what is going on there? Like we're there. Like we're telling you.
Let's know if we got a T-Rex on our hands or if we got a velociraptor on our hands. Which one's going to be more deadly? And it's basically because one of our key words for our company is we give a shit.
Trying to shut the door in the kitchen, and the velociraptor sees her. He's going, and she's like, oh no, you're gonna get me. Hopefully you like all the education that you're getting from Manley and I. Do us a favor and smash that like button, subscribe and follow, and tell all your friends and family about us.
Welcome to the Mortgage 101 podcast with Anthony and Manley.
In this prehistoric segment, Manley, we're going to know our species. Our species is the modern first-time buyer in this shifting market. So what's going on here? Rates are easing. The question is if they're going to drop more. And when they drop, how much? Now, every 0.25% drop is going to pull in more buyers into this market. If we see a 5 in front of these rates, we're going to see over 5 million more qualified buyers getting in line to purchase.
It's just crazy that we're going to add that many, and we're probably not going to get that many opportunities. The market's going to get a little nutso. But hey, they also should know that we don't need to just put 20% down. Think about that 3% down conventional or the 3.5% FHA. Hey, with the conventional, we can go down to 620 credit. With that FHA, we can go down to a 580 credit score. Waiting for that perfect rate can mean twice the competition. I don't suggest it. We've been saying this. Move along.
Yeah, I mean, we see that the demand is up and the prices are up. So getting in earlier can help beat those bidding wars. We are also seeing a lot of sellers pulling back. You know, there is a lot of sellers currently that were trying to get that, 3-point shot from a distance, not understanding that these buyers in this market are not going to pay top dollar like we saw post-COVID. So they're now starting to get acclimated and go, okay, these pipe dreams of selling the houses for historically high while these rates are historically high, they're coming into a new world where they're going to have to price it right. They're not going to be doing fire sales, but we're definitely seeing a shift in how many listings are on the market, which is not going to help the supply and demand.
If you want to get a home run, prep now. Get yourself a pre-approval, but better yet, get yourself fully underwritten with one of our power bids. That's what's going to win the game. That's what's going to take us over in the walk-off home run. That's how you're going to be standing up there pointing to the gods above and saying, thank you for this big grand salami that I just hit out of the park.
Yeah, and for those of our listeners who don't know what a power bid is, so obviously Manley and myself are vice presidents of mortgage lending in our region for rate, and we do what is called a power bid. And what that is it's basically we put you through underwriting before you find the house. So a lot of people would ask, why would we do that? Well, it's simple. We are going to make sure there are no hurdles in front of you in order to get that house, and we're going to make it as quick and streamlined and as painless as possible. So how do we do that? We vet everything out up front. Verification of employment, income, assets, credit, everything is certified. So that way when you start shopping, you shop with a blank check. You know your payment. You know you're out of pocket. More importantly, the seller sees that you're fully vetted. If there's 4 or 5 people lined up, who do you think they're going to take? They're going to take your offer because you're fully underwritten approved, not just pre-approved. So it's super important to talk to your loan officer to say, hey, can you get me fully underwritten approved before I shop? So that way we can make sure there's no obstacles in front of us. That's a game changer in this market.
And the real beauty of it is how quickly we can close after you've done that. My question is always, why wouldn't you do that? Because we're going to do all this work anyway. Let's do it up front. Let's know exactly the animal we're dealing with. Let's know if we got a T-Rex on our hands or if we got a velociraptor on our hands, which one's going to be more deadly. That velociraptor is pretty quick and shifty. I think I want to be the velociraptor in this mess and have that power bid so we can go out there and win these offers, hit that home run. I want to hit the grand slam and knock it out of the park. So the power bid is really key to this game, and not trying to toot our own horns too much, but we have it. Not everybody does it, and not everybody does it like us. So there you go.
Yeah, like you said, it's survival of the fittest. It's predator versus prey, right?
Yeah.
And so speaking of that, let's talk about some survival gear, right? What to have ready before you hunt. Now, when we say hunt, obviously this is a prehistoric segment, so we're not expecting you to hunt like a velociraptor or a T-Rex. But you as a homeowner, you are a hunter. You need to be laser focused. You need to have the eye on the prize. You need to be 2 steps ahead of the prey. In this case, it's the seller. So what does that mean? We need to be ready. We need to have our 30 days worth of pay stubs if you are a W-2 employee. You need 2 years tax returns if you're self-employed. If you've been self-employed for at least 5 years, a lot of times we only need 1 year. We also need 2 months of bank statements, 60 days for conventional, 30 days for FHA, and that's to make sure we can season where this money's coming from. We need a government ID. We need to make sure we see all your debts so we can do your debt to income ratio. And then we're looking at down payment. Are we using savings? Are we using 401k? Are we using mom and dad? We talked about that last segment. Or are we doing down payment assistance through a state or government grant? There's a lot of options there. Just a matter of what the buyer needs, what you need as a buyer. Just know that there's no obstacle that a good lender like Manley and myself can't overcome. The more we know, then the more we understand how we're going to get that prey into your mouth. In this case, it's the home.
Anthony, we're back to this conversation again, and we're kind of circling with the same thing, but the power bid, the power bid, the power bid. It reads like cash to sellers. You want to have that absolute arrow in your quiver that's going to take them all down. If we're out hunting, like we're using those metaphors right now, it's the king of the jungle. It's what we're taking care of. It's our grand slam. We need to do that. We can't implore with you enough. Take advantage of the power bid that we have to offer.
Yeah, and it's pick your lane too, right? It's like not only, get approved, but get approved with the lane that you want. Are you going to go FHA? Are you going to go conventional? What does the mortgage insurance look like between the two? What type of reserves do you need? That money that you're not going to have to use, but has to still be there. Speed wins when it's the right home, and the right home appears instantaneously. Just like if you're peeking around in that forest and you see that little tiny 3-horn triceratops, yeah, those raptors, they're going to have some dinner. The same goes with borrowers. If a borrower drives and sees a house they want, and it's an open house that's been on the market 1 day, and it's a house that is hot, meaning they don't have to do anything to it. It's in the right school zone. It's in the right area. It's got the single story. It's got the RV parking. If you want that house, you need to be prepared, which means you need to be confident.
Talking about all this stuff, we're going to make some Raptor traps. Shifting from negotiator to competitor. This is all we're talking about right here is what can we do to put ourselves in a better position to make you as strong as you can when you're negotiating? As rates fall and leverage shrinks, your focus is going to shift from what I'm getting a deal to, no, I need to win this house. What do we got to do that?
Yeah, there's a lot of things that our buyers can do if they switch from getting a deal to I need this house, right? And we get that all the time from our clients. They're just gonna be like, hey, we're looking at this house, or a lot of times we get them approved, right? And they're like, all right, we're going to start shopping. And then, we're going to survey the market. And then they call us and they're like, oh my God, we found the one. And we know that when we get that phone call, it's no longer, I'm trying to get the lowest deal to save, $20 on the payment with, $30,000 to $40,000 price cut. They're like, no, what do we do to win this house? And there's things you can do. You can make a bigger earnest deposit, which signals certainty, meaning you are putting money where your mouth is and you want this house, aka a bigger deposit. Now, deposits are safe because they're with a third party like a title or an attorney. It's not with the seller. So as long as you meet your obligations, you're good. 100% of that earnest deposit goes toward whatever you're out of pocket. The also misconception is that you can lose it. You do have protections like contingencies, whether it's an appraisal or a loan or an approval. As long as you're within those contingencies, then if for some reason you have to back out or walk away and you're within those contractual guidelines, you get that money back. There's no problem there. You can also update the inspection time window, the contingency date, whether it's the inspection for the house or the appraisal. You can shorten that window so that way you show the seller, hey, I mean business. I'm trying to get this closed quickly. I've even seen people do escalation clauses, which basically state, I want this house. I'm going to give you this offer, and I'm going to continue to go up higher than any other offer that comes your way by $1,000 or $5,000. So if I start at $400,000 and the house is worth $400,000, and I say I'm going to do an escalation clause up to $450,000 in 5,000 increments, what you're telling the seller is, I'll go up to $450,000 if someone goes up to $445,000, meaning if no one else shows a bigger offer above $410,000, you're going to offer $415,000 and seal the deal. You don't have to pay $450,000. You've only paid $15,000 over. You did an escalation clause to show the seller you mean business. You will pay over whatever anyone else in the market is wanting to pay plus a certain amount. That usually wins the deal in a lot of markets where there's a lot of buyers.
Really helps. Really helps. Hey, you can also tighten that closing timeline too, especially with our power bid that we keep talking about. Like, we can close these things in 7, 8, 10 days. The legal limit, that we can get it done. All these things can really up your opportunity to negotiate like a boss and control the scenario, control the situation, and get yourself down. If we're putting low down, we're going to not use that TBD approval. We're going to use a power bid, and we're going to show proof of funds through a letter from us. And then we're going to clean up those contingencies and wipe that all out. And you're going to have a really strong offer on your hands.
Yeah, we're just going to take away all of the question marks, right? Because that's what it's about. Our job as loan officers is to dispel all the misinformation and wipe away the confusion and replace it with concentration and confidence. And the same goes with the seller. If the seller sees clean contingencies, like you just said, proof of funds and really being proactive and not reactive, the seller is going to be more prone to take your offer. And it's all about setting up. Like you said, Raptor traps. We want it to be foolproof. We want to make sure if you're coming our way and you cross that trap, it's hook, line, and sinker. It is done.
If you guys are liking all the information you're getting from us, if you're feeling that we're educating you, please smash that like button, subscribe, DM us with any thoughts or ideas for our show, and also tell your friends and family about it. Share us on social if you can. Would love it. Oh my gosh, look what time it is. It's the ever popular rate prediction tracker update from Command Central again. Tell us, Anthony, what's going on?
Man, so rates have dropped fast after the NFP, right? September cuts. They're at 80%, I believe, the odds. Our forecast was between 5.8 and 6.5. That's still holding strong. It's definitely on the lower end of that forecast too, which is what we wanted to see.
Yeah, Anthony, as we track this along, January, we were at like 6.69. We were talking about hot inflation, sticky inflation. February, we were talking about CPI as it cools off. We were at 6.52. March, we saw our first rate cut priced in, and we were at 6.38, so it kind of went down a little bit. April, it kind of screeched down a little bit, but the Fed put that pause on inflation, and all that stuff came out, about tariffs and all that fun stuff. crazy. We were at 6.33% at that time. And then May came down, jobs slowed, and optimism faded. But we still squeaked our way down to 6.27. And then in June, inflation kind of moderated out, and we saw 6.19% in our thought process of what we're going to see. July, even better. NPF revision shock. Everybody found out, and they fired the person who's making these crazy decisions. Kept going down, 6.13%. Well, guess what? Roll around to August, we're at 6.07, in our prediction. That's the lowest since October 24. Again, the stocks are mixed on all this. MBS near unchanged, but hey, this is looking really good.
Yeah, I mean, Governor Bowman, he signaled a 3-cut forecast, 75 basis points before the end of this year. When we look at that paired with the unemployment flirting with around 4.3%, a 3-month job average at 35,000 with more revisions coming, you know how they do it. They send it to us and revise, send it to us and revise. This is all good signs, especially for the CPI, right?
Yeah, I mean, this is great. The CPI headline is a huge headline for today. The bonds rallied with the core CPI coming in almost perfectly, hitting around the forecast number, which, again, we're starting to see a sign there. Some heads rolled because of all the nonsense that's been happening and how it's been affecting the market. So riddle me this. How are we so close to the predicted and what we thought was going to happen? Well, hey, our next big thing is the shelter is our next big swing factor, and it could have an impact on what's going to happen.
Yeah, I mean, right now, buyers need to be talking strategy. And there's going to come a time within the next couple of weeks, we are done talking about rates being in the 6s. If the CPI is tame and we see sub-6 prints, expect a buyer swarm. Lock the home now, refi later. You can't rewind if prices jump. Like we said, just imagine a market with 5 million more borrowers in it. We are right there at the footsteps. We are telling you before it happens. You can call us Houdini. We are that magic 8-ball where you shake it and you see the purple sauce and go, oh my gosh, what is going on there? Like we're there. Like we're telling you. And so we're going to be able to look back at these segments that are, mid to end year. And in November, December, we're going to look back and go, you remember when we were talking about upper 6s and now we're upper 5s? In less than a year? And can you imagine now we're having to do like waiving our contingencies, and now we're talking about how sellers are forcing the buyers to pay their agent's commission, and now they're going to see 15, 20,000 more in cost, all because they waited 6 months for a higher price with a longer line and a longer, it's like, what are you doing?
When September rolls around and the feds do make a cut, which they should, it's going to be interesting.
Now, we're in the hunt, right? The borrower is in the hunt. So when you're in the hunt, you have to have tools, right? You got to have an arsenal of tools, programs plus timing. Choose strength, not just the lowest down. 3.5% is great. 3% conventional is great. VA and USDA, nothing. That's the right program, but choose the one that's going to make your offer the strongest. A lot of times people will see, and this blows my mind all the time because you and I both know that the amount of money that someone puts down does not dictate how strong the buyer is at all. No. We can have people who are putting 3.5% down, first-time home buyers, have plenty of money in the banks, 800 FICO, yet they'll go for someone putting 10% down, having to do an alt-doc loan bank statement because they came out of a bankruptcy less than 2 years ago, and they're looking at it going, well, this is stronger. It's 10% down. Yeah, no, it's not. That's where we come in, your lender. But really, choose strength and choose the right program because, like we talk about, half the battle is getting approved, half the battle is getting your offer accepted.
Big deal getting those offer accepted. And if these rates continue on, we've been talking about it in this podcast alone, we get to that 5 handle, we're adding all those new buyers are now qualified that they weren't before. It's going to change the trajectory of housing prices. And let's see if we can jump in before that and get her going.
We talked about, choosing the right strength, the right loan, whether it's FHA, 3.5, or conventional 3, or like the no down USDA and VA. But there's also a budget play, like different programs within those walls. whether it's Freddie Mac CHOICEHome, which now includes single section homes, which single section homes is basically manufactured homes, right? And there's also now new construction, where before it had to be existing, whereas now they're allowing new construction manufactured housing where you find the plot, you convert it to real property. And we're seeing more and more of that because there's just less and less land to build on. So they're having to get, creative. So include those single section homes with 3% down or modern build qualities. You're looking about markets that are adding 200,000-300,000 to the purchase price by now being able to leverage these programs and these types of homes. Whereas before, they were out of the reach. There was no programs for it, or there's no places to do it. There's a lot of these sites now that are able to be built. And so it's just a question of not only understanding which program you're going to be using, but what asset you're looking to purchase, right? And we get that all the time. We have to make sure that the asset can be purchased or financed. A lot of manufactured homes can't. If it's pre-1976, if it's single wide, not double wide, if there's multiple dwellings on there, if the well is close to the septic. There's a lot of little things like that, not including the single family homes or the PUD or the condos, or there's so many things that we look at. The big question is, what are you going to be bringing to the table? Is it less contingency? Is it easy to close? And is it full transparency? That's what the sellers want.
All right, guys. It's the ever popular rapid fire buzzwords round. It's the what does it mean and how do you use it edition. So let's talk this through. We have our producer Marty in studio today. He had a few buzzwords that he wanted to ask about. So Marty, take it away.
Absolutely. Thanks for having me in today, guys. First buzzword or words, I was hoping you could help explain the difference between a pre-approval and a TBD approval.
Yeah, I mean, it's what we were talking about earlier, Manley. A pre-approval is great. We get AUS or, quick automated approval. We get some pay stubs and some asset statements, but it kind of stops there. Whereas a power bid or a TBD full approval, that's where we actually send it to the underwriter to get the income, the credit, the assets all certified before you find the house. That's the strongest signal to the sellers. And so you definitely want to ask your lender for a TBD approval, or in this case, a power bid approval, what we do here at Rate.
Next buzzword, DTI or debt to income.
Hey, that's when we're talking about your housing debts, which would be your new principal and interest payment, your homeowner's insurance payment, your property tax payment, mortgage insurance if you have it, or if you have any homeowners association dues, condo dues, anything like that. All those would be your all-in number, and we're going to divide that by your income. And in conventional, we'd love to see somewhere between 40 and 43%. We can go as high as like just under 49%, maybe tipping over that. FHA, we can stretch that to near 50% with compensating factors. And if we can crush some of those small debts, we can raise the approval power. So
in the world of debt to income ratio, there's front end and back end, right? And so front end is your housing payment. Back end is your housing payment plus every other payment. Like Manley said, the credit cards, the car loan, all that good stuff. And each one play a different part. And each one are important to make sure that there are protections in place to make sure you're not over expending yourself. We do not want you to have a house on a hill stocked full of top ramen. We want some Chipotle in your life. And that's why the DTI is in place.
You love hot dog soup, Anthony. I know you love hot dog soup.
Yeah, no meat for me over here.
Oh, that's right. The vegan hot dog soup, even better. They make those things,
Right.
Oh, goodness. Moving on.
Moving on. Next buzzword is LTV, loan to value.
So loan to value basically is how much are you putting down, right? So in other words, if you have a $100,000 loan and you're 95% loan to value, that means you've put 5% down. 95 plus 5 equals 100. And if we have a $100,000 loan, you put 5% down, that's $5,000. So you got a $95,000 loan amount or a 95% loan to value. Same thing when you look at mortgage insurance. you need to have a 80% loan to value or less to not have mortgage insurance, meaning 20% down. 80 plus 20 equals 100. So the more you put down, the more it's better for not having mortgage insurance. So loan to value is all about how much you're putting down.
Excellent. Moving on, our next buzzwords here are PMI and MIP. What might those be?
Well, Anthony touched on it a little bit, but conventional PMI is anything from that 80 to 100%. Well, actually, we're not doing 100% for that. We're going to do 97%. So you're going to put that private mortgage insurance in place when you're putting less than 20% down, and all that stuff is going to come in. MIP is something that FHA puts on, and that changes a little bit when you depending on your credit score and how much you actually are putting down, but it is your upfront mortgage cost that's a permanent one-time fee that gets added right to your loan. So it's a little different than private mortgage insurance. It's the upfront mortgage insurance fee.
Basically look at two things, right? You've got conventional and FHA. Conventional has monthly mortgage insurance, which is a part of your payment, right? PITI, principal interest tax insurance. So conventional has monthly, but does not have upfront, meaning we tack it on to the loan. FHA has monthly and upfront, meaning if you have a $100,000 loan, they're going to add 1.5 to 1.75 of the loan amount to the purchase. And so you're going to see an extra couple thousand on your loan amount that you're adding into the loan. That's the upfront mortgage insurance. So you want to make sure that, are you going to go down the road of conventional where there is no upfront, or are you going to go down the road of FHA where there is upfront? Now the question is, why do people go FHA if they have upfront mortgage insurance? Why would they do that? Well, it's because traditionally FHA has a lower rate than conventional. And it's for first-time home buyers who don't have the 780 FICO. Maybe they got 620 FICO. Or, maybe they're first-time home buyers and they don't have a big credit profile. This all affects the type of program that the buyers want to look at. And no matter if you're going conventional or FHA, you're still going to pay mortgage insurance unless you put 20% down. With FHA, doesn't matter if you put 20% down or 50% down, you still have mortgage insurance for the life of the loan until you refinance. So with FHA, it's always a pit stop. It's never a set it and forget it loan. It's always to get you into the race, to get your horse into the track. And then once you have some traction, let's get rid of that horse and let's pony up to a better horse, aka conventional.
One other good thing to mention regarding that monthly mortgage insurance that happens with FHA versus conventional, if your credit score is lower with conventional and that's 700 or below, your monthly mortgage insurance starts getting very costly because you're a higher risk. And with FHA, it's static. It doesn't change. It doesn't get affected quite as bad by your credit score. So again, lower interest rate on the mortgage itself, and then you might be able to stack that with a lower monthly mortgage insurance rate. So the two of those combined might make you cash flow or have a much lower monthly payment altogether. So there are those times where you're borderline. You just got to have somebody work the numbers for you and let, as we always say, let the math tell you what to do. It might clearly outweigh that upfront mortgage insurance fee that you put on. So let your lender, like Anthony and myself, talk you through that, walk you through the math, understand what your possibilities are. And again, hey, Marty, sorry for getting really long-winded. I just had to jump in there and add that little tidbit. It's an important piece.
Moving on to the next one, points and credits.
I love this one. Points and credit are the biggest misconceptions that we see. When our clients see points on what is called a closing disclosure or an LE, loan estimate, LE is loan estimate, CD is closing disclosure, and they see points, they automatically assume this is 2007, and the lender is getting points on the front end and the back end, and they're just raking it in. I can tell you right now, Manley and myself and every lender that is basically CFPB and TRID enforced, they do not make money off of your rate. They do not make money off of your program. They make money off of the volume that they close in. So if they close on $500,000 house, the bank pays them based off of that volume. Our commission is not based off of points or rates or programs. So our fiduciary obligation stays with the consumer Pre-2007, it wasn't like that. It was like, hey, it was Wild West. You didn't have to be licensed. There was points on the front end, points on the back end. It was like Oprah, you get points and you get points. And the only person that was stuck was the buyer going, oh, that was a $45,000 cost on a $200,000 loan. But now just know when you see points, that's rate based, meaning there's a par, meaning it's no cost to that rate. So say the par 6.5%, meaning no points. Now you can buy that rate down to 6.25, 6.375, 6%, 5%, but you're going to see more points, meaning it's going to be more costly. And the adverse way is you can raise the rate and get a credit to go towards your closing costs. So we always want to look at, and Manley and I and every lender who's worth their grain of salt is going to look at the break even, meaning how much is it costing you for the loan versus how much you're saving to see that break even period. Now, when rates were in the twos, we were just stacking on that cost to, I was even locking people at 1.875 at one time because they knew that they were never going to refinance that loan ever again. Whereas when we are in nothing but rate degradation, we're going to see nothing but rate decreases. Then we know that runway's short. And so we're going to say, hey, in the next 2 years, it's very likely that whatever we're doing, we're going to refinance now. So how much are you going to save in 2 years? Oh, you're going to save $1,500, but it's going to cost $5,000 for that rate? That doesn't make economic sense.
Makes no sense.
So,
Makes no sense.
We want to look at that, but that's the rate is tied to the points, and you want to make sure you're looking at that because math never lies. And you never want to do something that's not out of math and that's based off of fear. So that's what the points are. The credits are whatever credits you're getting. So a lot of times in this market, you're getting credits from the sellers, seller concessions, or for buy down. And so those credits get applied not to the down payment because that can only come from you, but the concessions go to the closing cost of the loan, the third parties, title, escrow, taxes, county, appraisal, all of those fees can be covered by seller credits, agent credits, or lender credits.
Cannot exceed either. Cannot exceed the overall cost. And there are some rules for percentage amounts depending on conventional FHA on what those lender credits or concessions can look like. Whole nother category.
Yeah.
Boy, are we long-winded.
You can't just get $100,000. It's it's 3% for conventional unless you're putting 10% down. You can go up higher. It's 6% for FHA, and there's a lot of wiggle room. So just get with your
Big
lender.
point is you can't walk away with a check.
Our next buzzword would be seller concessions.
Well, we just kind of talked about that a little bit, but that's where there are specific amounts, as we just talked to. FHA, we can go up to 6%. Conventional, we can go 3% if you're putting 10% down, or as high as 9%, depending on the loan to value and occupancy. If it's your primary residence, if it's an investment, it's a totally different thing, or a second home. So, and those have to be used to cover specifically the closing costs, all the ancillary things, your title, your closing costs, your lender fees, your credit reporting fees, all those things. Your homeowner's insurance can be boiled into that. Your escrows for taxes and insurance can be boiled into that. Your homeowner's insurance for the first month, for the first year can be put into that as well. So pretty simple. Seller concessions specifically, know what your limits are. Yeah, and
as a caveat to that, here's a cheat code for you guys in the lower price markets. This doesn't apply to where I'm at in Hawaii, where the median household price is $1 million, or we're licensed in every single state with rate companies, so we can take care of you everywhere. But places like Georgia or places like Michigan or Massachusetts, these places you may see like a $200,000, $250,000 purchase price, and you're still going to have $10,000 to $15,000 in closing costs. It does not matter on the price. Whether you're doing a $200,000 home loan or $1 million home loan, you got sunk cost. So a way that you can avoid, if you're doing a conventional and you can only get 3% on $200,000, that's $6,000. So if you got $15,000, you're leaving money on the table. You're leaving $9,000 that you could potentially get the seller to pay. How do you do that? The cheat code is this: have the agents strategically write in the contract that the sellers are organically covering all of the closing costs. So it's not tied in the middle like 50% the buyer, 50% the seller. If they organically make the purchase price, the seller's paying all the closing costs, then you can use that $6,000 for strictly rate buy down, because all of the title, escrow, and everything else is organically contractually obligated to the seller. So therefore the seller's not paying the buyer's closing costs. It's the seller's based off of the contract. That's how we get away with still only being able to get $6,000 from the seller in concessions, but covering all the cost associated with the closing to where they're only paying the down payment. That's the cheat code.
That's a cheat code, baby. I like it.
Last one, rate lock and rate float down.
Gotcha. Oh, that one's a really good one, and not sure every lender does this, but we do this, and it's a great product. We've talked about this before, but we're going to bring it back to the table. When we lock a rate today, and let's say we're locking you at 6.5% or something like that with no points.
You're giving free hot dogs again, Manley? Is that what
I'm
it
giving
is?
free hot dogs. Yep, I give out them free hot dogs,
that
and
it?
then free secret stadium sauce on the brats I give, and the sauerkraut. But when we lock that rate at 6.5%, and then 2 weeks after we've locked it, that thing goes down to, the rates keep falling down, and we get down to 6.125. Guess what? We're going to give you a one-time float down to that 6.125. We have to have that 0.3% move in the interest rates. So we're going to float you down to that level as a one-time courtesy to keep your business, keep you happy. We couldn't predict the rates. We're locking you to protect you, because when they went up to 6.875, how would you feel if I called you up and said, hey, I know we locked at 6.5, but now we're at 6.875 just because rates went up? That's not how it works for us. It's going to give you the benefit of the doubt. We're going to lock you in, and we're going to give you that one-time float down. If the rates move 0.3%, no cost to you, we're going to do it one time. That's a really great product and a really great effort that we do here at Rate. And it's basically because one of our key words for our company is we give a shit.
Yeah, that's the slogan for Rate Companies is we give a shit, which is true. And like you said, we want our buyers to sleep well at night knowing that they're locked. They're not going to wake up to any surprises. But if there is a surprise to the good, then we can take advantage of it. And so that's always good that we have that ace up our sleeve.
Thanks for that great section there, Marty. Always love the rapid fire buzzwords. Appreciate you, brother, for coming in and saying hi and having a quick combo, asking us those great questions.
Hopefully you like all the education that you're getting from Manley and I. Do us a favor and smash that like button, subscribe and follow, and tell all your friends and family about us.
All right. This is the new section that we added last week, the new segment. And this is the big W for the week. We want to hear something great that happened in your business and something that moved you. And I want to hear your big W for the week, and then your big win. What did you do? What made your earth move this week besides the volcanoes that are happening in Hawaii?
It reminds me of that segment in Jurassic Park where the girl is like trying to shut the door in the kitchen, and the velociraptor sees her. And he's going, and she's like, "Oh no, you're gonna get me!" And then he slams right into the mirror or the glossiness, and she was right at it. That reminds me of exactly what we need to do in this market. It's kind of like the slide of the hand. For instance, I had a client this week. They wanted the house, but they also wanted the rate. What I mean by that is like they want the 2-1 buy down, which is a big ask. If you have $1 million loan amount, you're talking $50,000 we need to get from the seller. Now they're going to save that in the payment by dropping the rate down 2 percentage points the first year and 1 percentage point the second year. But when you ask that, it muddies the water to where if there's other offers, the seller's going to go, I'm going to go with the least amount of resistance. So we now have a 2-1 strategy for the 2-1 buy down where we offer a clean offer and we wait for that offer to get accepted. And then when that offer gets accepted, we then go for the jugular. So it's the slide of the hand, or it's the let the raptor hit the fake wall, so to speak. Yep. And once we are in contract, the seller can only say no. They can't say, no, we're not going to go with your offer and we're going to go somewhere else. So we get them, we get the hook in, And then we go to them and say, hey, the lender just came to us and offered us an amazing program. We want to build it into the purchase price. So if it's $1 million purchase price, we need 50,000. We're going to offer you $1,050,000. You're going to give them 50. You still net the same, and the buyer gets that 50. And now they can work the market to their advantage for the next 2 years to subsidize their payment. And if and when that changes, which it's definitely going to be within 2 years, they could take advantage of it. And we are having 100% success to where the sellers are like, yes, absolutely. There's no change in my game. There are some that go, well, I have to pay an extra 3% in concessions on the purchase price. So what we do is we already have an answer for that. We tell them, we're going to bake that in. We're going to ask for this amount minus the 3% in concessions that you would be paying. So that way the seller is whole and the buyer gets the buy down opportunity, because it has to come from the seller. It cannot come from the buyer. The buyer can't fund this account when you do a 2-1 buy down. So that was a success. I was able to get a smooth offer accepted and then go for the jugular, do the slide of the hand trick, and then let that Raptor or let that seller hit a wall and realize that they're still getting the best deal. It's just the deal that's best for both sides, not just for one.
Yep. No skin off the teeth for the seller. There are concerns when you have those kinds of conversations sometimes, like, is this going to appraise for that? And then what happens? Well, we're going to make an adjustment when that occurs. If for some reason the appraisal comes in short, Mr. Seller, we by no way, shape, or form expect you to cover that gap. Obviously, we're going to talk about that and we're going to reduce whatever it is we're trying to accomplish. That's the only pushback when we've tried to do those things over here that we get if we're in a tight market. But this is a typical thing that I love to work on. Just like you're saying, I love to find that sweet spot. Where is the seller happy? And then come back to him and say, oh, by the way, we have room in here to negotiate at this point. You're still going to get what you get. We just want the seller credit so that my buyer's in a better position, and we're going to take advantage of that. As long as you work with me, Mr. Seller, we're going to amend the contract, and it'll be no skin off of your teeth. It's a great job. Love it.
Yeah, it's a strategy
Way to
too.
work it.
You want it not to come from the agent, not to come from the buyer. It comes from the lender, right? Because hey, this lender just showed me this amazing thing, and most sellers have a heart, have a conscience, and they're buyers as well, right? They're on the other end as well. They're going to go, oh, well, yeah, I don't want to add an inconvenience or obstacle. There's no skin off my back. Absolutely. Let's do it.
Awesome. Well, I had a big W this week. It actually was, middle of last week it started, but past customer Ryan came and said, hey, we really weren't looking for a new house, but we found this great opportunity, and we need to get pre-approved like right now. And I'm like, okay, well, if you can jump on my app, fill it out, let's get you going. In 15 minutes, they had it filled out. An hour later, I looked it all over. You guys are golden here. Let's jam this through. My team, we whipped together a power bid. We got it that afternoon. So we're talking the whole, not 24 hours transpired. We're clear to close. We're closing on Friday. We had 6 business days for the whole thing, title work, all the stuff that had to happen. Like, it's just crazy. So we're going to close on the 9th day from the time that we actually started the application. So big win, super stoked. You needed the right people to jump on board and get you all the documents like now, so I could get it in front of an underwriter. And that's, again, why our company just love it. They jump, when we need you to jump at times. So
that's a great story. And
big win.
that leads into automation, and AI is taking over the world. And it's going to be a different world in the next 5 years of the likes we've not seen since the Industrial Revolution. And we are leveraging it for our buyers right now. And those power bids also have all those automations with assets, with income, with employment, where usually it takes 3 to 5 days to get those back. Instantaneous now. By the time it's even submitted, we have a chart showing income verified, assets verified, employment verified, all done. And like you said, not only is it a power bid, but it's a clear to close in less than 10 days.
We got the appraisal waiver, so the other part of the process was getting the title and everything in order, the insurance in place, and just, everything was done like within 24 hours because we got the waiver. We got the accepted offer the next morning, so we could confirm we still have the waiver, and we're rocking and rolling. We're just, putting the puzzle together to get these other parts. There was a small gift involved, so that we had to move some money around for that. Did it the right way. Boom, done, over. It's
Amazing.
like piece of cake.
Good story. Good W.
Yeah, love it. Yeah. Final thoughts. It's simple. We got to win both halves here. We got to win the approval process, do that power bid, but as important is we have to win that acceptance. So we have to help you craft a really strong offer, be part of the team with you and your realtor partner, and make this happen. And that's how we can control the outcomes. And, the seller is leaning in this market. We have to jump in there and attack.
Yeah, I mean, you want to be like a velociraptor in this market, right? A velociraptor, they prepare early, right? They move fast and they use their tools. This real estate market is your jungle. Hunt smart, hunt fast, and prepare. And you will feast, and you will feast well.
Yeah, yes, sir. Find your Barbasol can. Hey, thanks for watching our show today, you guys. I hope you found this helpful and informative. Hey, please like and subscribe. Press that subscribe button down below. And we'd love some comments and some feedback if you got it too. Thanks again. Hope this helps. If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.
Hey, Manley.
Yeah, Anthony, what's up?
Knock, knock.
Anthony, we said we weren't going to do this anymore.
Knock, knock.
Anthony, you promised we were done with this knock, knock.
Knock, knock.
He never quits. Who's there?
Velosa buyer.
Oh, Lord. Velosa buyer who?
Velosa buyer who got TBD approved, used an escalation clause, and ate 6 offers for breakfast.
Way to bring it back to our ever-friendly show we're talking about, Jurassic Park. It's a good one, folks.